Sources indicate, though this hasn't been officially confirmed, that Treasury holdings were significantly affected by unexpected Fed signals, reshaping portfolio strategies across markets this year. Recent market volatility suggests investors have been reassessing their fixed income allocations in response to shifting monetary policy expectations from the Federal Reserve. The initial reports emerged from major financial institutions tracking changes in central bank communication patterns throughout the first quarter. Market analysts have noted that these subtle shifts in Fed rhetoric preceded several significant moves in bond valuations, suggesting sophisticated investors may have positioned themselves ahead of official announcements. These Treasury holdings adjustments represent a fundamental recalibration of how institutional investors are approaching long-duration assets in the current economic environment. Portfolio managers globally have indicated they are paying closer attention to every word from Federal Reserve officials, searching for clues about future interest rate decisions and quantitative policy adjustments. The unexpected nature of these Fed signals caught many traditional bond investors off guard, forcing rapid portfolio rebalancing across pension funds and insurance companies. Several major asset managers reported larger than anticipated outflows from their Treasury-focused funds as clients sought to reduce duration risk in their portfolios. What makes this situation particularly noteworthy is the market's sensitivity to even minor deviations from established Fed communication patterns and historical precedent. Investors who had built their strategies around one set of assumptions suddenly found themselves needing to reconsider their fundamental outlook on interest rates and economic growth. The reshaping of portfolio strategies has not been limited to Treasury specialists, but has rippled across the entire fixed income spectrum and into equity markets. Corporate bond investors and municipal bond managers have similarly adjusted their positioning based on the implications of potentially higher interest rates for longer. Implications for individual investors extend beyond institutional portfolios to impact bond funds, retirement account allocations, and savings strategies for ordinary Americans. Financial advisors nationwide have been fielding increased calls from concerned clients seeking to understand how Fed policy changes might affect their investment returns. The timing of these signals during a period of elevated inflation concerns has amplified their market impact significantly. Economic data released simultaneously with shifting Fed communications created additional uncertainty about the true trajectory of monetary policy going forward. Market commentary from leading financial institutions suggests that transparency from the Federal Reserve may need improvement to prevent such disruptive surprises. Some analysts argue that clearer forward guidance would allow markets to price in policy changes more gradually and predictably. The Treasury market's reaction demonstrated how sensitive this crucial market segment has become to policy uncertainties and shifting expectations. Bond traders have reported increased volatility in trading activity as positioning shifts in response to each new piece of Fed-related information. Global investors have also taken notice of these dynamics, as U.S. Treasury yields influence investment decisions worldwide and affect currency valuations. International portfolios holding significant dollar-denominated assets have been forced to reconsider their exposure to American debt instruments. The longer-term implications of this reshaping include potential changes to how central banks communicate with financial markets in the future. Central banks globally may need to develop more sophisticated communication strategies to manage market expectations and reduce the potential for disruptive surprises. Corporate finance departments are also evaluating whether now is the time to lock in long-term borrowing rates or wait for additional Fed clarity. Chief financial officers are delaying major capital expenditure decisions pending better visibility into the interest rate environment. The real estate sector, which is highly sensitive to Treasury yield movements, has already begun adjusting investment strategies and deal-making activity. Real estate investment trusts have reported shifting their debt maturity profiles to adapt to the changing interest rate outlook. Credit spreads across the corporate bond market have widened somewhat as investors demand additional compensation for holding risk assets. This widening reflects a flight to quality as some investors exit riskier positions to raise cash and increase liquidity. Derivative markets have shown increased activity in interest rate futures as traders hedge against potential Fed policy shifts. Options markets have also reflected elevated expectations for interest rate volatility over the coming quarters. The technology sector, which benefits from lower interest rates and discounted future cash flows, has been particularly affected by these Treasury yield movements. Growth-oriented stocks have experienced pressure as investors reassess earnings models under assumptions of higher discount rates. Looking forward, market participants will be watching closely for any additional Fed communications that might provide further clarity on policy intentions. Investors are preparing multiple scenarios for how portfolio adjustments might proceed depending on future Fed actions and economic data releases.